Okay, today we're going to dig into the IPO for Andersen Group. And I know what you're thinking, an accounting firm. Sounds pretty dull, right? But what if I told you that hiding inside the seemingly boring IPO is one of the most fascinating and, frankly, brilliantly designed business models out there? Let's take a closer look.
I mean, on the surface, this is exactly what it looks like. It's a bunch of tax advisors deciding to go public. We've all seen this story 100 times before. Nothing special to see here. Or is there?
Because what if this isn't just another IPO? What if it's a business that was engineered from the ground up to perfectly exploit the weaknesses of its biggest competitors? What if this whole thing is a masterclass in turning a massive liability into a world-class asset? Now that's the real story we're going to get into.
Right, so to really get our heads around this, we need to understand the core idea that has so many analysts buzzing. They're not just calling Andersen another stock. No, the term they're using is quality compounder.
So what in the world does that actually mean? Well, think of a quality compounder as a company with a really strong, defensible position in its market, what investors love to call a moat. It makes great returns and, crucially, it can reinvest that money to just keep growing and growing year after year. It's like a snowball rolling downhill, getting bigger and bigger. It's the absolute dream for long-term investors.
And to understand Andersen's moat, its big competitive advantage, we have to rewind and look at its pretty dramatic, almost unbelievable origin story. This is not your typical garage startup tale, that's for sure.
Okay, so back in 2002, the name Arthur Andersen was basically radioactive, completely destroyed by the Enron scandal. But while the firm itself collapsed, 23 of its top tax partners, led by the guy who is still CEO today, they just refused to give up. They bought their own practice and started a new firm called WTAS. Then, in 2014, in a move that was just incredibly gutsy, they rebranded back to the Andersen name. And from there, boom, they exploded into the massive global network you see today.
So you have to ask, why on earth would they bring back such a tarnished name? Well, here's the thing. For the C-suite execs and the super rich, the name Andersen didn't just scream scandal, it also meant the absolute gold standard of technical skill. It was known as the Marine Corps of accounting, totally elite, incredibly rigorous, the best of the best. This rebranding was a huge calculated risk that paid off. It instantly told the world, the experts are back.
So they had this elite reputation, which they absolutely leveraged. But that's not the whole picture. This is where their strategy gets really, really clever. It's not just about what they do, it's about what they don't do.
You see, the big four accounting firms, Deloitte, PwC, EY, KPMG, they make a ton of money from auditing public companies. But here's the catch. Regulations like Sarbanes-Oxley mean they can't provide a lot of other high-value consulting and tax services to the same companies they audit. This creates a huge conflict vacuum. And Andersen's genius move? They just flat out refuse to do audits at all, which means they have zero conflicts of interest. They can just swoop right in and grab all that juicy, lucrative work that the Big Four are forced to pass up. It's brilliant.
And you know what? Once they land a client, that client almost never leaves. Why? Well, for one, trying to change your high-end tax advisor is an absolute nightmare. It's super risky and a huge operational headache. Second, look at the numbers. 74% of their revenue comes from clients they've had for more than 3 years. That's incredibly sticky. And finally, think about it. The tax code is only ever going to get more complicated. Their services are always in demand.
And this chart just perfectly illustrates their premium spot in the market. Look at that. They generate $335,000 in revenue for every single employee. That completely blows the industry average of around $230,000 out of the water. This tells you they're not just a company billing by the hour. They're a company billing for incredible value, for solving unbelievably complex problems that almost nobody else can.
This whole premium service model also connects directly to their global strategy, which is another part of the story that's really smart and honestly often misunderstood.
So, Andersen goes toe-to-toe with the Big Four all over the world, but it doesn't actually own hundreds of offices globally. Instead, it uses this clever setup called a Swiss Verein, which is basically just an association. High-quality, independent firms in different countries join the Andersen network. They get to share the brand, the quality standards, and a referral system, but they stay legally and financially separate. This lets Andersen have a massive global footprint without the insane cost and risk of owning everything. It's capital-light expansion at its finest.
Okay, so we've got a fantastic business model, a super powerful brand, and a brilliant global strategy. But, and this is a big but, a great business does not always make for a great investment. To see why, we have to look at how this whole deal is structured. And this, my friends, is where the major red flags start popping up for public investors.
Just look at this breakdown. It's pretty wild. After the IPO, the original partners and insiders are going to control 98.9% of the voting power. Public shareholders, they get a tiny little sliver, 1.1%. What that means is, if you invest, you have basically zero say in how this company is run. It's what's called a controlled company, which means it's even exempt from rules that require an independent board.
Oh, and it gets better. Well, better for them anyway. There's this super complex financial tool called a Tax Receivable Agreement, or TRA. Here's the bottom line. When the company gets certain tax benefits from going public, it is legally required to pay 85% of those savings directly back to the insiders. We're talking about a potential payout of over $413 million over the next 15 years. That's cash that's not reinvested in the business, and it's not going to public shareholders. It's going right into the partners' pockets.
So the crucial takeaway here is that you have to weigh all the other risks too. The visionary CEO who started it all, he's 71. That global association model, well, a scandal at a member firm somewhere else in the world could instantly tarnish the entire brand. You know, exactly what happened with Enron. And, kind of ironically, for a firm that's all about financial expertise, they admit in their own IPO filing to having material weaknesses in their own internal financial reporting. Oof.
All right, let's pull all this together. On one hand, you've got a truly world-class business. On the other, you have a governance structure that's, well, deeply concerning for an outside investor. So what's the final verdict here?
I mean, when you just lay out the numbers, the quality of this business is undeniable. A 15% compounded annual growth rate, that's fantastic. An adjusted EBITDA margin of 32.5%, that's absolutely elite. Basically double what many of its competitors pull in. And its conflict-free model is a real, unique strategic weapon. Financially, it just looks superior in almost every way.
And that leads us to the final, critical question. This is the ultimate trade-off, isn't it? You have a chance to invest in a truly exceptional company. A business that's basically collecting a royalty on the ever-increasing complexity of the global economy. But the price you have to pay is giving up almost all of your rights as a shareholder. So is that a price you're willing to pay?